Dumebi Udegbunam, a fixed income trader at UBA, joins me now for a recap of trading at the fixed income and FX markets in Nigeria. Thank you so much for your time on the show today, Dumebi. Let's first look back and take a few steps on how this week has been for the markets.
For having me. So this week was quite an eventful week. We had a bond auction on Wednesday where rates hinged up on across all maturities. The 2027 closed at 12.25, the 2035 closed at 13.35, and 2045 closed at 13.85, which showed a clear higher view or a clear view of higher yields going in the market. But however, there was quite an anomaly in the auction. 42% of the auction wins were covered at the non-competitive offers, which clearly showed the sign that market participants wanted or FSA'd higher yields, but their demands were not met. At the almost side of the market, only 12.8 billion was sold. All rates were maintained at the long end of the curve, but reduced marginally on the 91-day bill and the 182-day bill. However, system has still been stressed with illiquidity, as the system, as we speak, is also still in a repo. This is the most times the system has been in a repo this period in the past 3 years. So we were really tight with system liquidity. We were expected to see a fact payment coming this week, but the fact payment didn't come out. So that's more for that stressed out the system right now. As I earlier spoke, in a repo of about 181 billion in the market, which clearly shows the general view of how tight the system has been. So generally, it has been an eventful week. However, the illiquidity still looms in the market with bearish sentiments on both sides of the curve, that is the bond side and the COB side of the market.
All right, illiquidity is still a major challenge in there, but when you look at how the market is going to play out in the near term, though, what else do you think would shape investor sentiments going forward?
Just so for next week, let's bring our expectations like a bit closer to next. So next week we have about 111 billion coupon payments coming in. So on the bond side of the market, that might more or less pour in a bit of bullish sentiments and cover off for those who didn't win at the auction. At the treasury side of the market, we only have about 40 billion maturing, which still shows a clear system of how the inflows are coming in the market. We might expect the fact payment to be paid next week, which would more or less spoil a bit of bullish sentiments. Also, for general issues, we are aware of the $1.5 billion that has been passed by the Senate, borrowing that would come from the World Bank, the Import and Export Bank of Brazil, and the Dutch Bank of Germany, which might help our FX reserves. As we all know, our FX reserves have grown by about 1.1%, adding about 300 million to the FX reserves, and an increase in oil prices. Oil prices have been up year to date by about 28%. So in the general view, on the FX side of the market, we expect inflow and a stable market. On the fixed income side of the market, we expect bullish sentiments on the bond side due to 111 billion coupon payments coming in. On the treasury side of the market, we might still see a bit of bearish sentiments, as only 40 billion is coming in, owing to bearing the fact that the fact payments might come in, so that might ease off that bearish sentiment going into next week.
Yeah, but looking at the yield curve activity, though, for you, especially for the bond and the T-bills market, though, where do you think we're going to see that value play out in the near term?
Okay, so as we're saying, we're seeing rates go as high as we saw in 2019. Let's take, for instance, the 2049 bond. As around this time in 2019, the 2049 bond was about 14.2. Right now, at the auction, it closed at 13.85. So this is a clear sign that we are going back to 2019 levels. If we do a 5-year cross-sectional analysis to where we're coming from 5 years ago, 5 years, the longest tenor bond was 2037, which was at 15.2. So we are seeing a trend, or we are seeing a comparison between rates, and we're seeing rates go higher marginally, but not as fast as we saw in previous years, as I earlier mentioned. So the overview for rates is higher use in the market, as we've seen in the general view of the market. Let's take, for instance, the US. Inflation's up at about 6.0% up right now. So rates in the emerging and the developing markets are up, so which more or less spurs into the emerging markets too. So we are seeing us move from a downward rate trajectory to an upward rate trajectory going forward into the year.
All right, then quite interesting insights when you put in there, talking about looking at most likely getting back to pre-pandemic levels there. But what's your take on what played out at the OMO auction yesterday?
So at the OMO auction, this is a clear sign that the CBN is comfortable at mopping liquidity at particular level and even reducing, owing to the fact that we're seeing a hinge up in the NTB markets and the rates in the NTB bills. The longer side of the NTB yield is moving closer to sub-9 levels right now. So, which is the main focus of the CBN right now, watching the cost of borrowing and not money in the system that they plan to mop up. So, from what we saw at the Omo auction, it's clear that they are comfortable mopping money at that or those levels, and they're also comfortable trying to borrow at the certain level as in the NTB market. However, a very big issue we should watch is our external, or should I say our total debt servicing. Right now, our total debt is about 31 trillion as at the close of year 2019, with a proposed Eurobond coming in and a $1.5 billion coming in from the, as I earlier mentioned, from the Import and Export Bank of Brazil, World Bank, and the Dutch Bank of Germany. We might see a huge increase in our total debt stock, which might be a very big worrisome part we should watch out, especially for the DMO.